Hi, this is Jim Welsh from macrotides.com. Thanks for tuning in. I think global growth in coming years is going to be weaker than we've seen in the last 30 to 40 years for a number of reasons. One of them is the effectiveness of monetary policy has already been diminished, and I think it's going to continue. Central banks always knew they could reverse a recession and ignite a recovery by lowering their policy rates, since most recessions since World War II were preceded by central banks increasing their policy rates and tightening credit. Simply loosening the tourniquet, constricting the flow of credit, and voila, a recovery would soon blossom. Central bank confidence, though, began to erode in the 1990s. Despite lowering its policy rate to the lowest level in the Bank of Japan's history, down to 0.5% in 1996, the action didn't result in an economic rebound. The BOJ learned an invaluable lesson, albeit too late. By the time the BOJ had lowered its policy rate to 0.5%, prices throughout its economy were falling, so that the inflation-adjusted policy rate, the real rate, was well above 1% and not as stimulative as the BOJ presumed. Japan had entered the black hole of deflation, and there wasn't much the BOJ could do about it. After the U.S. economy entered a recession in 2001, Federal Reserve Chairman Alan Greenspan lowered the federal funds rate to 1% and below the inflation rate to avoid the trap the BOJ had fallen into. Greenspan saw the policy mistake the BOJ had made and made sure the Fed didn't repeat it. Notice how the policy rates of the BOJ and the Fed since 1980 have posted a lower high at the end of each business cycle. Two conclusions can be drawn from this pattern. Each recovery has required even lower rates to get it going, and each recovery stalled at a lower peak in the policy rate. In 2000, the Bank of Japan launched an aggressive quantitative easing program to reverse the recession and deflation that developed after the Asian financial crisis in 1997. The BOJ's QE program included buying government debt, but also private debt and stocks. Between 1995 and 2000, though, Japan's GDP fell from 5.4 trillion to 4.5 trillion, while inflation spent more time below 0% above, despite the efforts by the BOJ. The financial crisis exposed a painful truth for the Federal Reserve and eventually the ECB. Central bank's primary and historically most powerful policy tool, the policy interest rate, was no longer effective. The Federal Reserve launched its first QE program in December of 2008, followed with QE2 in November 2010 and QE3 in September 2012. The ECB initiated its first QE program in 2015, and at the ECB September 2019 meeting announced it would initiate another round of QE in November at $22 billion a month. The financial system was on the brink of collapse in December 2008 when the Fed launched its first QE program. In my opinion, it stabilized the global financial system and very likely prevented another Great Depression from taking hold. While there should be little debate on the need and efficacy of QE1, the value of QE3 was minimal in economic terms, although it certainly helped inflate asset values far more than economic activity, and with the assistance from the ECB and Bank of Japan, asset values across the globe. Thanks for tuning in. May something positive happen for you today.